All right, ladies, let's get started. I know that we had some questions about TRID and RESPA and truth in lending. So, what we're going to do today is just kind of go over those three acts, kind of make sure you understand what they say, what they are, how they feel like they fit into the grander world of real estate. So, I've got some slides prepared. If you've got questions, just ask. Otherwise, I'm just going to kind of talk about it.
All right, yeah, these ones are kind of confusing to me, so this is
You are not
perfect.
alone. Yeah, you are not alone. Not at all, Mary. Not at all. Okay,
Uh,
so I was talking to another teacher. His name is Seth, and he's actually my podcast partner. And as soon as we record one, but he said it's the inception. And I said, the inception. And I was like, what are you talking about? He's like, it's like the movie Inception was a dream inside a dream inside a dream. He's like, well, that's kind of like these words. You got an acronym inside an acronym inside of acronym because TRID is made up of truth in lending, TILA, and RESPA. So you've got two acronyms that make up a third acronym. Let's break it all down. The biggest part of this is TRID. It's the most current and it's the biggest thing that you need to know, not necessarily from a testing point of view, but from understanding and quite honestly, from a when you get out there in the real world, if you're working with residential closings, this is going to affect you. So I like to think of TRID as a story. If I were to go back prior to 2016 and I asked you, hey, what could you tell me about laws that have to affect closing or that you have to follow when it comes to a closing of residential real estate, you would be all over the place because there were a whole bunch of laws. There were a whole bunch of rules and there's paperwork and all of this stuff that all related to a residential closing. And it was confusing. Not only that, and one of the most important parts of that was the idea that there was a lot of duplicate paperwork. So if you had asked me prior to 2016, how long does a closing take? It took forever because you as the borrower would be filling out so much paperwork and some of it was duplicate. It was like one act or one law would say, hey, we need this piece of paper to say ABC and have the borrower sign off on it. And then we'd have a different piece of paper that needed to say CBA and you need to sign off on it. So TRID, one of the big major parts of TRID is the fact that it organized all of these laws and said, look, let's try to cut down on killing some paper. If we've got to say A, B, and C, which is the same as C, B, and A, let's just create a law that says we can use the same paperwork for everything. And that was the Dodd-Frank Act. So TRID comes from an act, the Dodd-Frank Act. And at its core, what the Dodd-Frank Act did was say, let's take all of these acts. So most of these things in the circle, and I'm going to make it so, well, you can see it. So when you see like the Fair Credit Reporting Act and the Equal Credit Opportunity Act and the Interstate Land Sales Full Disclosure Act, all of these acts around the circle, it was like the Wild Wild West. They were all doing their own thing. And there were laws and there were rules and all of these things that banks had to follow, or buyers or sellers or agents, whoever it may be. All these rules you had to follow. The first thing they did, like I talked about, is they said, let's consolidate some paperwork. And that's what TRID is about. And then they created the CFPB. So TRID comes from the Dodd-Frank Act. The Dodd-Frank Act is an umbrella over a whole bunch of other acts. And the Dodd-Frank Act created the CFPB. Now, I'm not going to go into a lot of detail on the CFPB tonight, just because it's pretty, I'm going to say it's pretty obvious what it is, but there's not a lot to memorize. It's the Consumer Finance Protection Bureau. So back in the day, prior to 2016, if you thought your bank was charging you something wrong or you thought they were doing something shady, who are you going to tattle to? The bank? Hey, bank, I think you're doing something wrong. And they're going to be like, Ann, okay, you're right. Okay, fine. But now the CFPB is like, oh no, the public has some place where they can go where you're like, hey, I think my bank is charging me something weird. And they go, oh, really? We will be glad to take a look at it. You want to see banks start to get their numbers correct and start to act right? Say, I'm just not sure this is right. Why don't I call the CFPB? Oh, no, ma'am. That's okay. Don't call the CFPB. We good. I'm sure we can figure it out. They are the oversight. They keep these banks in line. So the CFPB, remember that for real life too, Consumer Finance Protection Bureau. If you've got a buyer and you feel like your buyer, something's weird that's going on with the loan, have them reach out to the Consumer Finance Protection Bureau. That's one big thing. The other was TRID down here that you can see. TRID was created by the Dodd-Frank Act, and it stands for the TILA, RESPA, Integrated Disclosures. TILA, RESPA, Integrated Disclosures. So what I want to do is talk about what did RESPA say, what did TRID say, what did TILA say, and that's what makes up TRID. So actually, I'm going to start kind of big. We'll start with the documentation because that was a big part of it. So we're going to learn all about RESPA. And RESPA, it's an act, and we know an act is a bunch of laws. Some of the acts or some of the laws that RESPA, Real Estate Settlement Procedures Act, said is, hey, when a borrower borrows money from a bank, within 3 days, a banker, you need to give this buyer an estimate of what you think their numbers are going to look like. At the same time, Truth in Lending was saying, hey, lenders, we need you to be truthful. So within 3 days of, somebody applying for a loan, you need to give them an estimate of what these numbers look like. They were both estimates. They pretty much said the same thing. So it was duplicate paperwork. And then both acts said, hey, when somebody closes, they should have an accounting of where all these numbers came from. So there's this, with RESPA, there was something called a HUD-1 settlement statement. And then with Truth in Lending, there was once again another disclosure that said, hey, here's what's all the numbers are. So we merged everything together. RESPA required the good faith estimate, the GFE. TILA required the early Truth in Lending. Instead of having 2 sets of documents, we said, TRID says, let's just use this one TRID form called the loan estimate, and that's going to cover the requirements of what you needed for RESPA and for TILA. So TILA said, have one document. RESPA said, have another document. TRID says, let's just use one document to cover both. The other document that they consolidated was the HUD-1, which is your end closing document like a receipt. That was from RESPA. You had the final Truth in Lending from TILA. They basically said the same thing. So all of a sudden, now we have a closing disclosure. It is one document that solves the problems of both acts. So that right there was a lot. Any questions about any of that? Did that clear up anything for somebody? Or we already knew it?
And those 2 documents, you have to turn them in 3 days before the transaction's complete, right?
Well, close. So the loan estimate has to be given 3 days after a borrower applies for a loan.
Okay.
And then the closing disclosure has to be given 3 days before the buyer can close on the loan.
Okay. All right. That makes a little more sense.
Yeah. The loan estimate is an estimate. So if you, Mary, went to go buy a house and you were getting a loan at 5% interest, and they were saying you had to pay points or you needed to pay a origination fee or any of those things, you should be given a document within 3 days of applying. That's an estimate of what they think all those fees are, so you have time to look at them.
Okay.
But it's an estimate because right before you close, you're going to be given the closing disclosure 3 days before. That's going to be a final accounting. Hey, we thought you were going to end up paying no origination point, origination fee. And what do you know? You still aren't paying an origination fee. Or we thought you were paying 2% in a loan origination fee. And what do you know? You're still only paying 2% in a loan origination fee. And let me tell you why this is important. So before, because, I've been licensed for more than 20 years now. I would sometimes go to closings, especially before 2008. And let's say, Mary, you were getting ready to buy a house and you would have applied for the loan, and the lender would sometimes say, hey, Mary, on top of your down payment, maybe you had a down payment of $20,000. We're going to charge you $3,000 in closing costs. And you're like, okay, that's cool. I got that. Then you wouldn't get the closing disclosure. You wouldn't get that final piece of paper, that final receipt, until the day of closing. And all of a sudden, you owed $5,000 in extra fees.
Oh, wow.
Isn't that weird? The people who know your exact financial background, history, and how much you have in the bank, all of a sudden, like, oh, we need $2,000 more if you want to close. I mean, what are you going to do? Not pay the extra $2,000? You're right there. You can see the keys. You are about to buy your house, and now there's this number that changed.
Yeah.
So this is to help keep things above board, stop things like that from happening. You're going to be given, and any buyer is going to be given, this loan estimate. So you have an idea of what things are going to be. And then before closing, you get this final accounting. So if they said no origination fee, and then all of a sudden they jumped to an origination fee, that's a problem. And to tie it all together, who do you contact if there's a big difference between the loan estimate and the closing disclosure? The CFPB.
Okay.
Because before you were just calling the bank like, hey, I don't think you can do this. And the bank's like, maybe not. But now the CFPB has huge rules about, hey, that loan estimate that they give you has to be really similar to that final closing disclosure, like pay big fines similar. That example I just gave you, where you went from no origination fee to 2% origination fee, those would be some big fines, like expensive. Even the bank doesn't want to pay them fines.
Oh, man.
Right. So now you can see where the CFPB becomes very helpful and why it's such a big part of the Dodd-Frank Act.
Yeah, it's definitely a lot of help.
Yeah. Okay. So there's those two disclosure forms, right? And what I want to point out is that ending disclosure form. And I'm talking about this one right here, the CD. So on the test, if they mean loan estimate, they will usually write out the words loan estimate. If they mean closing disclosure, you're going to see the words closing disclosure. But heads up, when you get into the real world, if you go into residential sales, you might see the words LE or the letters LE or CD. One of the big features of the CD is that it takes that closing disclosure and it makes it two different forms. One for the buyer, one for the seller. Why is that? Well, that's because in our world now, it is none of the seller's business what type of loan, whatever's that the borrower is getting. So let's have a buyer. Let's call her Renee. Renee's getting a loan to buy Jaleesa's house. Is it any of Jaleesa's business how many loan origination points that Renee's getting, what her percentage is, like no, that's none of Jaleesa, the seller's business. So part of what TRID does is says, look, we're requiring you, bank, and whoever's doing the closing, the title attorney, whoever it is, we have to give this disclosure. But this is about keeping the buyer's information quiet. It is none of the seller's, business knowing about the buyer's loan. So we're going to have two disclosure forms. One form is going to be the buyer's closing disclosure that has all of the numbers that has to do with the buyer's loan. The other closing disclosure is going to be the seller's closing disclosure, and it is just focused on the seller's stuff. Now, funny story. The seller's closing disclosure says, oh, the seller has to pay this much in commission. The seller has to pay off a loan, blah, 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 blah. Yeah, that information on the seller's stuff is actually also included on the buyer's. So the buyer gets to see the seller's information. This buyer's closing disclosure has buyer information and seller information. The seller's closing disclosure only has seller information because this is about protecting the consumer with the loan. The borrower is the consumer when we talk about CFPB. They're the ones getting a loan, right? So we got to make sure, and it's part of the law, nobody can share the borrower's confidential loan information without the borrower's permission. So I see your question, is it entirely for residential or does it also apply to commercial loans? I'm going to table that because we're going to talk about what applies, like RESPA and Truth in Lending, who it applies to, because that's where those rules are going to come from. So I'm going to table that for right now, but we will talk about that. But I can tell you, for the most part, it's almost always going to be residential banking loans. Like if you're getting a loan from a friend, no. You're getting a loan from a bank, yeah, you're probably going to be talking about TRID. So when I say 3 days, remember the loan estimate has to be given within 3 business days of applying for that loan. 3 business days. So if you apply for a loan on a Monday, they got Tuesday, Wednesday, Thursday to get you that form. You have to have it. Then when we get to the end of the transaction, they've got 3 days before closing that the borrower must have the buyer's closing disclosure. Remember, this has the borrower's information and the seller's information. And nobody really cares if the seller's stuff is private. This law anyway. So you want to close? You want to close on Thursday? We've better have that information before the end of the week. That's just how it works. Now, remember, I said that part of this was that banks would act a little shady and they'd be like, what? Those loan origination points? We don't know what you're talking about. What? We're asking you to bring $2,000 more? You don't say. Well, part of what this law is, and this is just giving you some examples. If there are differences between what the loan estimate says and what the closing disclosure says, then you're going to have to stop. And now you're going to have a conversation. The borrower has to have a conversation with the bank. And then they're going to have to be like, oh, let's figure this out and get a new final one. So what I'm trying to say is if you got your loan estimate and then you got your closing disclosure and what you were quoted for the APR increased by more than 1/8%, if it was a fixed rate loan, or if it increased by more than 1/4% for an adjustable rate loan, that's when everybody has to go, oh, hold on. You have a major change from what you gave me in the loan estimate. So now we're going to have to talk about it, make sure everything's good. And now we got to wait. Does that make sense? Or this can happen too. More than likely what you're going to see. Let's say that, you're going to close on a Thursday and you get a closing disclosure. And then you sit down. So let's say you get the closing disclosure on Monday. You sit down on Thursday and it's different. If what they gave you to begin with, that closing disclosure, if it changed by more than 1/4%, if it's an adjustable rate, the APR, we got to have a discussion. And now we have to wait 3 more days before we could close. You gave me one closing disclosure and now you're changing it and it's changed by this much. We got to have a discussion. Does everybody see how this is to protect the borrower?
Yeah.
Because that's what we're here for. We don't want banks to act shady. How many of y'all really think that banks don't act shady sometimes?
Oh, they do.
If you're the borrower and you had been told at the loan estimate or that closing disclosure, no prepayment penalty, and then all of a sudden you go to sign the final paperwork and there is a prepayment penalty, oh no, that's going to stop. There's a change, new 3-day waiting period. You thought you were getting an FHA loan, but they surprisingly moved you to conventional. What just happened there? Nope. Wow. That's going to cause a new 3-day change. And that 3 days is to allow the borrower to check everything out. And if need be, call the CFPB. This law was about protecting the borrower. So overall, there is so much when it comes to TRID. At the end of the day, if I were to look at TRID as a whole, it's mostly lenders and the people preparing the closing documents that have to know all of these rules for TRID. As agents, it's up to us to have a general understanding. And when I say general, I do mean general. Like you should know, oh, there's a change 3 days. Oh, there's something different called the CFPB. Like it's up to us to know that kind of stuff. But who's going to have to know a lot of the details? The lenders, the closing people. That's it. TRID is really, really extensive. I just want you to have this idea about the CFPB and those new documentation. So in general, lenders should have to know. So lenders have to know this. And this kind of goes to what somebody asked. Lenders should know if you are going to be using that closing disclosure, it had better be with a closing that was covered under TRID, or I should say under Truth in Lending and RESPA. What that means is no commercial, no cash sales. No commercial transactions, no cash sales. They cannot use the new forms from TRID if it is commercial or cash. And I want to be very clear here. There are other parts of those two acts, RESPA and Truth in Lending, that it could be a commercial deal or something like that, and you do have to follow it. But when it comes to these forms, if it is a cash deal or a commercial deal, they cannot use that closing disclosure. They got to go back to the old HUD 1, what was required just from RESPA before there was TRID. If somebody were to ask me, well, how would you kind of sum it all up? I would say TRID did to closings what HIPAA did to medical offices. And I know all of y'all have been to the doctors, and every time you do something, you're signing HIPAA this, HIPAA that, HIPAA this, which is good. I'm complaining, but you know, it's illegal for your bank or a nurse to share your medical information. Well, guess what? It's illegal for a loan person, a real estate agent, whoever it may be, to share the borrower's loan information. It locks it down. One of the things you'll notice is that I said business days. And if we're talking about TRID, our business days are Monday through Saturday. We don't include Sundays or the federal holidays. That's one of those great testable points. Oh, if it's TRID, we're talking about business days, Monday through Saturday, no Sundays, no federal holidays. I know this next one on the top, it says delivery to agent is not sufficient. More than likely in your classes, you all would have learned that, hey, if there's an offer from a buyer and then the seller accepts that offer, they sign it, the seller could tell the buyer or they could tell the buyer's agent, and that would count. Not with TRID. When we comes to TRID, we are not included as, oh, telling the buyer's agent is the same as telling the buyer. Getting a copy of the closing disclosure to the agent is like giving it to the buyer. Nuh-uh. We are not part of this party. If we're talking about TRID, RESPA, Truth in Lending stuff, they can't give it to us and say, oh, it's like I gave it to the borrower. No, ma'am. And of course, if you're a dual agent, if you have, that shared responsibility, make sure you keep the borrower's information confidential. Donna, is that a question? I wasn't sure your hand was up. I wasn't sure if that was a question. Okay, good. But if you have one, ask. Now, remember, I said that, y'all, we are just responsible for the general ideas. But I know each of you in your classes had to learn about like credits and debits and who's paying for what. TRID is one of the reasons why. You may not be the person filling out the closing disclosure, but let's say there was supposed to be a credit to the borrower. The borrower was supposed to get some money. And maybe it was the seller who was supposed to pay it to cover some closing costs. If there are large mistakes like that, that is on you, as well as the lender, as well as the person who performed the closing. You have a responsibility to make sure that those closing disclosures are filled out correctly. So no, it's not just one of those, oh, there's a closing disclosure. Oh, no. I mean, not only should you be searching to make sure your commission is correct, but you should be looking it over to make sure there's no major glaring errors. If there are, the buyer has every right to sue you and the attorney or the closing title person and the lender. You are not excluded from making sure this is right. So that's kind of TRID. Any questions on any of that? Do we feel better about what TRID does, kind of says? Yes. The two parts, CFPB, and then you've got just the integrated disclosures. That's one thing. So now let's talk about it again, but let's talk about what RESPA says individually and what TILA says individually. Remember, TRID is TILA, RESPA, integrated disclosure. Yes, you can be tested on TRID, but you can also be tested on what does RESPA say? What does TILA say? Now I'm going to start with RESPA, the Real Estate Settlement Procedures Act, otherwise known as Regulation X. I'll be honest, you don't hear it called Regulation X a lot, but it could be. So I would add that to that list. I know you've heard me say, oh, you should be making a list of your synonyms, or you maybe got one for me. Then you need to include Regulation X. It's a federal act. I don't care where you are in the United States. You have to follow this. And it says all of those things that are bulleted, those are things that have to happen or have to be followed with RESPA. RESPA says, oh, this bulleted point, this is true. This is what I'm saying. Now, I'm going to get to those bulleted points because those are a lot. First, I want to talk about the fact that RESPA, and you see it in green there, does not apply to a land contract, an installment land contract. Does everybody know what that means? Is there anybody confused on what a land contract is? Or can anybody tell me? That's an even better question. Who can tell me what an installment land contract is, or just a land contract? No.
When
ahead,
a
Billy.
seller finances a loan,
Yes. How so?
like when the seller gives the seller cash,
Well,
or
that would be a purchase money mortgage. A seller financed purchase, when the seller says, oh, you need to borrow $400,000. Here, I'll give you $400,000 right now, and you pay me back slowly. Purchase money mortgage. But an installment land contract is where a buyer makes installment payments to the seller, and then they don't get title until it's completely paid off. It's like layaway. You know, if you've ever had something in layaway or ever watched a movie where somebody had something on layaway, you make a payment, you make a payment, you make a payment. And then when you finish paying, then you get your item. That's an installment land contract. Like you're going to make payments. You get to move in, you make payments, you make payments, you make payments, but they don't give you title until you pay it off. So all that is to say, RESPA does not apply to land contracts, purchase money mortgages, another type of seller financing we just talked about, loan assumptions with less than a $50 charge, 25 acres or more land. It doesn't apply to those. But it would apply to any federally regulated loan. So, the federal government would be involved in the rules, like there's no usury, charging more interest that's allowed. Like anytime they have to deal with some federal rules, then they're going to be following RESPA. This is going to be most of your residential sales if there is a loan. So having said that, what does RESPA stand for? This by far is my favorite acronym of the whole class. And I have lots of acronyms. Young kids eat up boogers, glue, and dirt. Young kids eat up boogers, glue, and dirt. Why? I don't know why this little girl picking her nose just makes me so happy. If it was an adult or any other kid, I'd be like, that's disgusting. But this little girl, I can just remember it. So RESPA requires young kids eat up boogers, glue, and dirt. Let's talk about what that means. So the Y stands for yield spread premiums must be returned to the borrower. Okay, so let's go back in the day. Let's go way back. And here's what would happen. So let's say Donna's going to Bank of America and I'm not going to give a bank a name. We'll make up a bad bank, right? So we'll call it Orange Bank. I don't know. You're going to Orange Bank for a loan. And so you would be told, okay, well, Orange Bank can give you a 5% loan. I always suggested when I used to help people buy and sell, I'd be like, hey, don't just go to a bank, go to a broker. So the first thing I want to say, does everybody understand the difference between a mortgage broker and a mortgage banker? No, okay, you don't, Donna. That's okay. So here's the difference. You went to Orange Bank. All they told you about was Orange Bank's products. Going to a mortgage broker means you might have somebody who could go to Orange Bank or Yellow Bank or Green Bank or Pink Bank. They have access to a whole lot of different banking programs. And then they're going to give you, oh, well, I can find who's going to give you the best interest rate. The downside is sometimes because that broker had to have access to all those different types of loans, sometimes you might pay more in closing costs or like fees because they had to have access to all the different loans. So, I mean, a lot of people would always just check out a broker and a banker. Well, if you went to the broker, Orange Bank could have said, oh, we can do 5%. Your broker would have come back and said, oh, we found somebody who could do 4.75%. But here was the kicker. What you didn't realize in little itty bitty print was that the broker found you 4.5%. But that loan, they basically said to the broker, hey, we would give Donna 4.5. But broker, if you can get her to take 4.75%, we'll write you a check for $25,000. Which now broker comes back and says, hey, Donna, we got 4.75%. You're like, oh my God, that's so much better. That's so much better than the 5%. And you didn't realize because you missed it in the small print that they made money off of you getting a higher loan. The bank had a greater yield. They made a premium off of you making sure they made sure the bank got a higher yield and they got a premium for that. That makes sense to you? So now you understand when I say yield spread premiums, the law, RESPA says, if that broker's getting a yield spread premium, they've got to give it right back to Donna. Which if that is the case, now all of a sudden they're coming to Donna and be like, hey, we got you 4.5%. It was about disclosure. It was about being honest. So the yield spread premiums are huge. I think that's really important that people know that that's a thing. All right. Now, kickbacks are prohibited. Who can tell me what a kickback is?
Just like you just got through saying, when instead of them bringing them to 4.5%, they would tell them to 4.75% and get $25,000.
Yeah, it's similar. I wouldn't say that's a kickback, but it would be like the broker saying, I like to use, depending on why they're doing it. So it would work. I think the inspector would be a great example. This would be if you're the agent and the inspector says to you, hey, every time you bring somebody to me, I'll go ahead and I'll give you a $500 check.
Yeah.
That's a kickback. And we know that is prohibited. Right? So you're not allowed to have kickbacks. We've got escrow account restrictions. We know that monthly you pay PITI. We pay PITI. And what that means is principal, interest, taxes, and insurance. So you know the bank collects the taxes and insurance. They're collecting the taxes and insurance. They put it in an escrow account to pay those taxes, to pay those insurance bills later for you. But if your tax bill is say it's $4,000 a year, they can't ask you to keep $8,000 in the escrow, $10,000 in the escrow. There's limits to how much they can have in there, and that's because RESPA says you can't do that. You've got the uniform settlement statements, the fact that we had this thing called a HUD-1, the fact that we have to have a closing document that's used around the nation. Yeah, that's because RESPA. It used to be called the HUD-1. But now with TRID, we use a closing disclosure that satisfies truth in lending's information too. There's a booklet that the bank has to give the borrower called Know Before You Owe. It's kind of like the lead-based paint addendum. We know, not addendum, but the lead-based paint book. You all know that booklet I'm talking about, Protect Your Family from Lead in Your Home. Well, you're going to have that same concept where it's a booklet from the government, except this one says, hey, you should know what a discount point is. Hey, you should know what a loan origination fee is. You've got the good faith estimate, which we talked about, the GFE. You have to tell somebody, hey, this is what we think your loan is going to be. And then the bank has to disclose whether or not they're going to have some other company servicing the loan. So when you have to make your monthly TI payment, somebody's got to keep track and make sure you paid and everything's going well. And, who needs to be called and said, you didn't make your payment this month. That's a loan servicing company. And if a bank's going to be using a third party to do that, they have to tell you. Young kids eat up boogers, glue, and dirt. So before I go any further, any questions on that? Okay, good.
So I have a question.
Yeah, go for it.
Okay, so there's a Regulation X and a Regulation Z.
Regulation X is
Is
RESPA.
for RESPA.
Regulation
And
Z
then-
is truth in lending.
Okay. All right. I don't ever remember hearing about the Regulation X. That's why I was kind of like, wait, what?
Mhm.
But okay, makes a lot more sense.
There you go. And Regulation X doesn't get used a lot, but it does get used every so often. So I like to cover my bases.
Well, that's good.
And then you can see from this screen, this is what's exempt. These are the RESPA exemptions, business loans. If you're assuming a loan and you didn't need a lender approval, any type of temporary financing, like a construction loan, you're converting a loan, like anything like this, any of these things here, you don't apply to RESPA. And that's a great test question. Like, is this going to fall under RESPA? Okay. Like some of the stuff, guys, on your test, I honestly believe these are a lot of things that you'll need when you get out in the real world. I also believe, why in the world would you need to remember the RESPA exemptions off the top of your head? There's a book, there's the internet for that. Having said that, I don't write the tests. So I'm telling you, just be familiar with them. Is it my top 10 things that you should know and be able to rattle off the top of your head? I don't think so. But should you be able to recognize when you see it? Most definitely. So I left this here just so you could kind of get an idea. But when we talk about there has to be a closing disclosure, there's that piece of paper that says it's a seller debit, it's a seller credit, it's a buyer debit, it's a buyer credit. That's what when we say closing disclosure, what we're talking about. Now, the other law that made up TRID was TILA, Truth in Lending. And it's exactly what it sounds like. Lenders have to disclose about all the credit charges and fees that they are going to be charging you when you borrow money. Now, how do they do this? Well, they do this by quoting what it's going to cost for you to do business as an APR. So I'm going to show you this picture here. I had to skip ahead. And this comes from a place called napkinfinance.com. So shout out to Napkin Finance if anybody's watching, or y'all, if you have questions about something financial, I love Napkin Finance. They have some great pictures that make it easy to understand. So an APR includes, and you see in the middle, it says annual cost of borrowing money. And to the right, it includes interest and guaranteed fees. Interest and guaranteed fees. So if you say, oh, I'm going to borrow money at 5% interest, but then they have another $20,000 in fees, do you see how in order to really say how much it's going to cost you, it's not going to cost you just 5%. It's going to cost you a lot more than that. An APR is the interest and the fees. What is the true cost of doing business? What are they really going to yield? What are they really making off of you? So again, I love Napkin Finance. If you got finance questions, awesome place to go look for like visuals. So what Truth in Lending says is, dear bank, you have to be truthful about your lending practices, about how much you are going to charge people. Now, this is going to apply to 1 to 4 family residences, but not business loans, not commercial loans, not agricultural loans, no farm loans. And we've already talked about, that Truth in Lending says, hey, you've got to tell people about what you're going to be charging them in a loan estimate within 3 business days of the loan application, which now we use the LE. Now, we'll say truth in lending when we're talking, whether it's I'm teaching in class or I'm talking to somebody, but the other name that it can be known as is Regulation Z. And whenever I think Regulation Z, not only do I think lenders have to be honest, specifically in advertising, this is when we get down to the nitty gritty, right? This is where we talk about, oh, you are required, bank, to share some information in advertisements. Little side note, a lot of people don't know that Regulation C says if you're the lender, you have to give a 3-day right of rescission. Somebody can change their mind on a home improvement and home equity loan. If you're taking a home equity loan out, you get 3 days to change your mind, but that does not apply to owner occupied. Like I'm just buying my regular old house. It does not apply there. But if it's a home equity loan, it's a home improvement loan, they have to give you 3 days to change your mind. So let's talk about this advertising thing. We know that there's always loans, and I'm always talking about how, and it's coming up soon. I love it. It's going to be December, and it's going to be Alexis, December to remember. Y'all know it's going to happen. You know it's happening. December to remember is coming. And whether it's that car loan ad or any other loan ad, there's always, you can finance, well-qualified buyers can finance up to 0% interest. Yeah, you know what I'm talking about, right? They always have that. Well-qualified buyers with 0.25% interest. You can own a house with only $5,000 down. Yeah, I bet I can. Right? But here's the thing. This is the part of the law that says, dear sexy voice, if you're going to give details about one thing, you've got to say everything. That's what they're doing. That's what Truth in Lending says. If I say, own this house for only 2 payments. Well, I guess if each of your payments is $250,000, you sure can. If you tell me the amount of a payment, how many payments, how much the down payment is, how much you're going to give me for interest or anything having to do, this loan will only be for 3 years. The term of the loan, if you say any of that stuff that sounds oh so appealing, then it triggers them to give more information. You can't tell half a story. If the loan says, or if the ad says, own this house with only $5,000 down, then they have to say, how much was the house? Was the house only $5,000? Was that really down, or was that my whole payment? Like, what was the actual price that we're talking about? How did you get that $5,000? What kind of down payment do I have to have? Own this house for only $500 a month in monthly payments. Did you require me to put $100,000 down? Like what kind of down payment did this require? How many payments am I going to have giving these details? How much are those payments going to be? When are they due? How much am I actually going to pay you if I keep this loan for the entire life of the loan? How much is that going to cost me? And let's just be honest. Let me know how you're making out here, bank. What's the APR? If in that loan, that sexy voice comes out and says any of those specific numbers, they are forced to in the itty bitty print, or I'm going to talk real fast. So maybe you don't know what I'm saying. It's going to go really, 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 really fast. That you think lenders wanted to tell you that information? Please. They are required to because they did an advertisement. They said one of the things on the top of this page, and it triggered them to have to tell all of the things at the bottom. So that's a big one. Give me a thumbs up, or actually voice, let me hear it. Did this make sense?
Yes, that was so helpful.
Yes.
Thank you.
Yeah.
Yes.
I love it. Woo!
I love the
So
way you do examples too. Make it more moves from abstract to like okay, and like
Yes.
that's because we've all seen a December to remember. Where's my Lexus and a red bow? Where's my I think my next car is actually going to be one of those Lexus SUVs. So Lexus, if you're listening, you could always give me one as a, as a thank you. All right. So I already mentioned the exemptions, but I'll mention them again. Business loans, commercial, agricultural loans. If you are somebody who's got more than 4 family dwellings, because at that point, it's basically an investment. If you got more than 4 houses, that's an investment property. So now that makes it not residential. And then most seller financing is going to be exempt. Again, these are great questions. Whether I know most of you all are getting your salesperson, but if you're getting your broker's license, that's a great question for brokers. So there you go. And just in case you're thinking it doesn't matter, think again, because you can be fined up to $5,000 for breaking this. So if you, once you all become agents, if somebody says to you, hey, I know you're doing this open house, I'll pay for your color flyers, but can I put this loan information on the back? As your flyer, and you let a banker put some loan information on it, and it doesn't meet all of the requirements for TRID / RESPA / truth in lending, that could be you facing these fines. So yeah, I understand we don't want to have to pay for color flyers, but you want to make sure they also don't get you sued. Because that imprisonment for up to 1 year, I don't know about y'all, but I'm not meant for prison. I'm not meant for prison.
Girl,
All
me
right.
neither.
So that's pretty much what I wanted to cover with y'all. Any questions that I can answer? I hit all the questions? What? All right. Well, if you all enjoyed this, and again, there's some other ones, we wanted to specifically go over TRID today. But are you all interested if I do some other sessions and doing some other like vocab words and topics? Should I add y'all to that list?
Yes.
Absolutely.
Awesome. Okay, guys. Well, then I will talk to y'all on Tuesday. You know, we got actually, I don't know if you're coming to the Monday nights with me and Maria. Those are free. If not, hit me up in an email so I can send you that. And guys, if you're planning on going this Monday, today is Friday for those people watching this recording, we're already almost full. So you got to sign up for those links. If you need that link, email me. Okay, email me so that I can get you signed up tonight. And it's on the Facebook page. I'm gonna hunt it down but I want to make sure you get in for that. Those are free with me and Maria. I'll be doing more of these. Again, thank you for letting me put this on YouTube because I want this to be available for people studying to help them. And then, you know, there's always our prep agent sessions. All right.
Yes.
All right. Thank you for doing this.
Oh, thank you. Thank you all for being here. It's hard to talk just to myself, but even though I did most of the talking, I can see y'all, I can see your faces and your names. That makes it better. So thank y'all. Everybody in the future that's watching this, they don't see you, but they're thanking you too, because you all gave up a Friday night for me. So guys, I will see y'all next time. Stay out of trouble. All right. Don't get caught.
You too.
Bye-bye.
All right. Bye, guys.
Bye.